Welcome to AllGen's Market Update. My name is Jason Martin. Today is March 19th, 2020. And wanted to talk about everything that's going on in the market right now. A lot of news with COVID-19, a lot of volatility. So I want to keep you guys informed and let you know our thoughts on everything. Here's the four things we're going to cover today. We're going to try to keep things in perspective. We're going to talk about what is doing well and what isn't. And then we're going to discuss the importance of rebalancing and then staying calm and focusing on the long term. So perspective matters. And a lot of times when clients call us about their accounts or just people talk about their 401k balances, they're looking from the recent high until what the market dropped. And so let's take a look at what's gone on since the recent high and this market drop. We're looking at the S&P 500, and we're looking here from February 19th, which was the high of the market, all the way to March 16th, which was the low of the market, and the S&P 500 is down 29% since its all-time high. However, this is the perspective I want to encourage you guys to have. Let me flip to the next screen here. Now we're looking at a chart over the last 40 years. And we're looking at 1981, this is the S&P 500, all the way until yesterday's close, the March 18th closed. So you can see just from the March 2009 up until yesterday's close, after that 29% drop, the S&P 500 is still up 260%. But the last screen I showed was only looking at this right here. And a lot of times people only focus on this piece. But this, if we keep a longer term mindset and we kind of focus on what the market has done over time, it helps you understand that yes, it's bad right now. However, the market's gone through this over time. This isn't the first time the market's pulled back. So let's take a look at a couple of the drops. We're officially now in a bear market, so I want to kind of look at the last three bear markets here. We had the crash of 1987, which was this drop right here. And from the standpoint of how quick it happened, then the crash of 87 is very similar to what we're going through right now. In fact, it had the largest one-day drop of all time, which was about a 22% drop in October of 87. But that was a 33% drop. Now imagine if I covered this area right here, and this is all you saw, and the chart stopped right there. It'd be similar to kind of what we're going through right now. I'm not calling the bottom that we're going to go up right now, but just from a visual perspective, you know, you don't know what's coming in the future. And so you had that 33% drop. There was a lot of people freaking out at that time, and the market eventually rebounded. And then you had the tech bubble, which was the drop from 2000 through 2002. And during that, you had the September 11th attacks of 2001. That was a 47% drop in the market. And then obviously you had the financial crisis. That was a 57% drop in the market. So, you know, this recent 29% drop that we did over the last month or so is, you know, not quite as bad as what the last few bear markets have been, but it's not too far off of what happened in the crash of 1987. My point of showing this is, and I'm not trying to predict how far the market's going to go down, but what I am trying to show is every single time the market recovered afterwards. And imagine if you were to sell, you know, panic and sell right here, or imagine if you were to sell right around this area, or sell right over here. Because the thing is, when you sell, psychologically, it's very difficult to get back in. Everyone thinks they're going to sell and then just be able to time the bottom and get right back in. That's not the way it works. People sometimes don't get back into the market till years after the bounce happened. And so if you sell right here and think you're going to buy back right here, it's just not going to happen. No one does that. What happens is people sell right here and they wait 3 years and they finally get back into the market back up here. So I want to encourage everyone to keep this long-term perspective. I mean, if you look here from 1981 all the way to yesterday's close, including the recent drop, including all these bear markets, the S&P 500 is still up 2,185% during that time. And that doesn't even include the dividends as well. So All right, moving forward. So what's doing well and what isn't? So the things that are doing well are U.S. government bonds. We talked a lot about this in the last few updates, that we held a lot of U.S. government bonds, and especially long-term U.S. government bonds, which have done well during this time. And gold has actually held up pretty well. Some agriculture like coffee and some other foods have been holding up well. Now, everyone thinks all stocks are falling. That's not the case. Some consumer staples are actually positive during this time. And I'm not going to name names because I don't want people to think this is a stock recommendation, but there are a lot of stocks that grocery store companies and just retailers that are selling food, that are selling hygiene items, that are selling, even healthcare items that have gone up during this time. Utilities have held up pretty well, and so has some technology, especially the technology that's been focusing on, video conferencing and working virtually. Those companies have actually held up pretty well during this time. So what I'm not saying is go out and buy those areas, but what I'm trying to say is not everything is going down. And if you have a well-diversified portfolio that has some of all of these, then you have some parts of your portfolio that are going up while other parts that are going down. So what's not doing so well? On the bond side, high yield bonds are not doing well. A lot of times when people buy bond funds or just buy bonds in general, they make the mistake of focusing on the bond funds that have had the best long-term return during good markets, and a lot of times that's high yield bonds. But those are the most risky, and they're the most correlated to the stock market. So when the stock market falls, they tend to fall as well, and those are getting hurt right now. Commodities, industrial metals, oil and gas have been falling quite a bit. Obviously, those are a lot more economically sensitive. And then energy, on the stock side of things, energy stocks, airlines, banks, industrials, hotels, and cruise lines. Those are getting hit very hard. The good news is, from an AllGen standpoint, is we are very underweighted in these areas. And especially, we don't have much energy at all. We don't have any specific airline stocks or hotels or cruise lines, and those stocks have fallen quite a bit. So, I bring this up not to make a recommendation as to what to buy or what to sell. I'm not suggesting that. What I'm saying is not everything goes down at the same time, and there are components of this market right now. Even though the stock market's fallen as much as it has recently, there's components of the market that are going up and different asset classes that are going up. So, which brings me to my next point, and that talks about the importance of rebalancing. So what is rebalancing? Rebalancing is where, and I'm going to give you an example here, that this comes from a Forbes article if you want to look it up, but does just a good job of explaining the importance of rebalancing and the impact of it. But rebalancing is where, and using this example, you have 60% stocks, 40% bonds, but let's say we had a moderate portfolio, which is 60% stocks and 40% bonds, and we go through a good market time, like a 2019, and stocks go up quite a bit, and bonds don't go up as much. So that would maybe bring your stock portfolio at that time up to about 65% stocks and your bonds down to 35%. Well, if you did a rebalancing at that time, you would sell some stocks and buy some bonds. And then right now, as the market's gone down, your stocks have fallen and your bonds have actually gone up. So maybe now your stocks are around 50% stocks and your bonds are around 50% bonds. Well, at this point, you would sell some of the bonds to buy some of the stocks. So that's what rebalancing is. And what I'm going to look at here is two portfolios. The dark blue one here, which is a rebalanced portfolio. And this example is just an annual rebalancing once a year. Since 1986, and this chart's a little bit old. It only goes to 2010, but it shows a good example of the benefits of rebalancing. So you can see with the blue line here, it's been rebalanced over time. You can see in the tech bubble, the stock market, the bear market that went from 2000 to 2002, the blue line held up better during that time. Same thing with the 2008, it held up better during that time. And over 40 years or so, the rebalanced portfolio did significantly better than the unrebalanced portfolio. And it did it by taking down less risk. You can see in this drop of 2008, it only pulled back 30%, versus an unrebalanced portfolio that pulled back 37%. And let me show you why this works the way it does. So this chart down here shows you the percentage in equities. So equities being stocks. So the yellow line would be the unrebalanced portfolio. You can use, and if you can remember, in the late 90s when stocks did so well, and especially the tech stocks, a 60-40 mix of stocks to bonds ended up becoming an 80% stock portfolio and 20% bonds. This is the percentage of what the stocks became as part of the portfolio when you didn't rebalance and you just allowed that piece to grow. And so the problem with that is an 80% stock portfolio and 20% bonds falls a lot more during the bad times than a 60-40 mix. And if you're not comfortable with that level of risk and you're a moderate investor and now your portfolio has become a moderately aggressive portfolio, you could subject yourself to a lot more volatility. So let me reinforce this point by showing you kind of what happened during the bad time. So if we look here specifically during 1998, which was a decent drop during that time, the rebalanced portfolio only fell 7%, the unrebalanced portfolio only fell 10%. So it only captured 74% of the downside. And the same thing, but on the other side, when the stocks were really strong, like from 98 to 2000, it didn't capture as much of the upside. It only captured 82% of the upside. But then look what happened during 2000, 2002. That bear market, it only fell 22% versus an unrebalanced portfolio that fell 32%. So it only captured 68% of the downside. So the point is here that during good times, you may not capture as much of the upside, but during the bad times, you capture significantly less of the downside. And over time, that tends to produce better returns while taking on less risk. So AllGen's approach to rebalancing, I gave you an example of an annual rebalance. We are big believers in rebalancing, but we focus on doing rebalancing based off of market movements. And so not just, January 15th every year we do a rebalance, but if stocks fall a certain percentage, then we do a rebalance. Or stocks go up a certain percentage, then we do a rebalance. That's when rebalancing is most effective, after big moves in that asset class. At the same time, we're not just rebalancing between stocks and bonds. That's a big part of it, but we're also rebalancing between different sectors, different market caps like large cap, mid cap, small cap, different regions, international, domestic, different bond duration, long-term bonds, short-term bonds. So if you do rebalancing across the entire portfolio, it reduces the risk even further and doesn't allow one sector to become overweighted like the late 90s. If you didn't rebalance, your technology sector would become very overweighted, leaving you with exposure when that eventually fell a lot. So we rebalance across the entire portfolio, and we do it after big market movements. So I want to give you a heads up for all of our clients out there. You've been seeing a lot of activity recently in your account. I've been very busy. And what I've been doing is I've been doing this rebalancing. We've been selling some of the bonds that have been going up, and we've been buying some of the stocks that have been going down. And it's very important to do that over time, just like I showed, because not only is it important to reduce the risk on the downside, but then at the same time, now that your stock percentage of your portfolio is significantly lower than your typical risk profile should be, now it's important to increase some of those stock positions. Now, I will say we've been doing that. At the same time, we're still postured defensively, okay? We've reduced a little bit of our bonds and increased a little bit of our stocks, but we're still postured more defensively. No one knows when the exact bottom is going to come, and we're prepared if it goes lower. However, after you get these big market drops, historically, if you add to your stock portfolio during that time, it usually ends up working really well in the long run, and we've been doing that incrementally. So it's really important that during these times, it's scary, and for a lot of people are really scared right now. Okay, but there's something happens when you're constantly, in a time like this, when you're constantly watching news, everyone around you is talking about the coronavirus, everyone around you is talking about COVID-19, you're hearing about this famous person that got it and that person that got it, and you're hearing about what's the total amount of cases around the world and what's the number of deaths around the world, and you hear that constantly. It just puts that in your mind, and you're feeding that kind of negativity, and it's growing on itself, and it just gets to a point where you're almost panic, and you try to you think you got to do something and you sell your stock. So it's really important to kind of take a break from that and to kind of focus, put your blinders on, try to get rid of some of that noise, and focus on the long term. So while you're hearing all that stuff, you're checking your accounts constantly. You're checking them 3 or 4 times a day. I actually read a great article from Carrie Schwab, Pomegranate, which is Charles Schwab's daughter. She writes financial planning articles, and she said, imagine if you had a goal of losing 20 pounds. And you checked your weight every hour, and you checked it by the gram, and you constantly checked and you got on the scale, every 10 minutes. And that would be very unproductive, counterproductive, one would suggest, but it would just frustrate you a lot of times. Well, that's kind of what you're doing when you're checking your accounts constantly. So we've done hundreds of financial plans with our clients. If we haven't done a financial plan for you, we would encourage you to come get a financial plan. But we've outlined in those plans the things you need to do to reach financial freedom. And we're looking over a long period of time, so I'd encourage you to stick with that plan. Keep doing the things that we recommended and putting money away. And focus on what you can control. There's a lot of things, obviously you can't control what the virus is going to do, but you can control some of your spending, you can control your mindset, you can control some of the things you're doing for your body, which is the last suggestion here, which is to stay healthy, to eat well, to get rest, to exercise. And I'm not a doctor or nutritionist, but something my family has always done is try to practice these good habits, but at the same time right now we've ramped up the vitamin C and the zinc and the elderberry and all the things that kind of help build the immune system. So I hope this helps, and I hope everyone is going to stay healthy, and I know we're going to get through this and everything's going to be fine. If you haven't done so already, click here to subscribe. We frequently upload market update videos on the coronavirus, provide financial planning tips, and relevant personal finance topics on our channel.